Hey, good afternoon, active traders, and welcome to Options, Indicators, and Breakouts with my colleague Larry McMillan. I'm Ken Calhoun. Larry, it's great to have you here with us today.
Oh, thanks, Ken. Thanks for joining me, or me joining you, whichever it is.
Yeah, and it's a great. We have hundreds of folks registered for today's event. I'm going to go up first, and then Larry will follow up. And great to see all of you here with us today. Just in the interest of time, we probably won't have time to answer questions as much as we'd like to. So appreciate y'all being here. All information is for educational use only. Who am I? You might have seen me at Money Show events. I've done as much as 4.9 million in a single year worth of trades. So I am almost seven, and now I'm up to almost 9,000 trades as of today. So I'm an active trader. Hey, one thing we're going to look at is directional volatility. And if you look at the strikes for say AMD versus CVS, one tip, let me ask you all a quick question. How many of you trade weekly options? That's question number one. And if you type yes, how many of you often go for the strike that has the highest open interest or highest volume, whether it's puts or calls? How many of you, number one, trade weeklies, and number two, if you do trade the weeklies, you tend to gravitate towards where the volume is at? Just curious. Because one of my tips or lessons learned, at least in my own experiments, is that often what's most popular is not the right strike to go after. And one thing that I want to start off by looking at in today's markets is directional volatility. And what a crazy market, right? This is a 2-day S&P chart. You can see we dropped on the China trade war fears. Right, Brian. Yeah, you do have to have liquidity. You do have to trade ones with decent liquidity, with decent volume. But if you're looking at your Greeks, looking at implied volatility, you want to make sure that you are trading instruments that have good, sustainable, consistent price action. And one of the biggest challenges the options traders I've worked with have is, the premium decay and your options expire worthless. And welcome to the options trader world. And one of the ways to get around that, or one of the ways to optimize your options trading activities, to make sure you're trading consistent, the strongest trend only types of instruments, assuming you're doing directional options plays. So, for example, one thing that, given the market's dropping now, it might not be a good idea to be looking for new long plays all of a sudden. It might be a good idea to start looking for buying puts in the S&P or whatever instruments you do to play the broad market. China trade war, no resolution this year. Maybe not such a big deal after all, right? The market bounced right back. Now, if you look at our S&P long term, we've got a surprising bubble rally, and it's widely expected we'll get the pullback right now. Now, one of the things here's a quick tip for you. Using the 2-day charts, a loss of 2 red candles in a row is almost always a good sell signal. So even if you don't have a shooting star or bearish engulfing or other reversal sign, if you see from a directional volatility standpoint a loss of 2 red candles, the loss of that support is often a precedent for a sell-off. So for example, now we do have 2 red candles, but I want to wait and see if the S&P loses 3090. It may well, even though we got a recovery into the close here today. So we have 2 red candles. If the market drops under 3090, we're going to look for a play to the downside. Now, let's talk a little bit about volatility. And I like working with Larry because he's an expert in volatility as well. One of the things that we're looking at the VIX is we've seen a triple bottom off the 12, and it's been surprisingly low. So we're trying to recover the 13. If we look at the 1-year chart, and I note that one of the CNBC technical chart master fella also noted this, that we've got a triple bottom at 12 in our VIX. We've got a bottom here, and a bottom here. Now, all-time low is way down, I think 9.7 a year or so ago. So we're not at all-time lows, but we've been in this congestion box for the last month. And so if the VIX does break out, I'm looking for congestion breakout above 14. That would be a good signal to start shorting the market, whether you're buying puts in the S&P related instruments like the spiders, or looking for, what I like to do is I like to trade the VIX ETNs because I like to live dangerously. Danger is my middle name, right? So I bought some VXX, I bought some TVIX, I bought some other inverse instruments like SQQQ. We don't want to catch a falling knife, but you do want to look for recovery if you see, for example, a high volume pivot. And so, for example, here in the S triple Q, it's a way to short the Qs. We have a high volume day today with two green days in a row. So we may get a pivot. Then again, it might be a dead cat bounce. Anyway, regardless of your directional bias, when you're looking for options plays that make sense, you want to focus on the charts that have the best directional volatility. So a couple of good examples that I showed you the strikes for. Let's tighten in our charts here. If we look at our 3-month in CVS, you could have done weekly options and seldom not had a winning trade because of the directional volatility. My expertise is not options. That's Larry McMillan. He's the world's foremost options expert, literally the writer of the book and world's top expert. It's a real honor to share the stage with Larry today. My expertise is directional volatility and breakouts. And so when it comes to which instruments you choose to play with, which instruments you want to do if you're doing directional plays, you want to make sure that you've got the strongest consistent trending instruments out there to work with. So CVS has been really good lately. It's gone all the way from 60 to 75. A little weak here the last couple of days. It still looks pretty healthy. And AMD is another example of one that I've covered in my live room continuously the last couple of months for my traders, and also good for swing trades and options plays. So if you're a weekly options trader, you're looking to get in at strikes that are likely to hit. And when you're looking at price projection, that's a critical part of figuring out which strike to hit. There's software out there that'll draw things like price windows and that kind of thing to estimate. But what you want to do is make sure that you start off with trades that have directional volatility that's most likely to continue in your favor. One of the things I found, I've been a full-time trader since 1999. I'm getting old. I hate getting old. I'll be 56 in a couple months. But but with time, millions of dollars traded, you learn every way to not make a trade and all the mistakes. And all the thousands of traders I've worked with over the years, when they ask about, hey, Ken, can you pull up this chart? It almost always is a chart that really stinks and has low volatility, low directional odds of continuing, not a consistent chart, but it had a recent spike. And that's not how to trade. What you want is directional volatility. Now, you can learn from my colleague Steve Nissen things like hammers, right? Or bullish engulfing hammer, even better. What I want you to do is, if you're seeing a pivot trade, make sure that you're looking for a recovery above all three, the 50, 100, and 200 SMAs. And that's often going to be the jump start of a good directional play that's going to work out for you. So back to our strikes. Let's take a look at our numbers. And one of the things that I want you to do is start giving some thought to where makes sense. I mean, if you have, you're looking for things like not only the highest volume, your eye should instantly always be drawn to the numbers, right? Traders vote with volume. So you can quote me on that. Traders vote with volume and they profit from volatility. That's a writer downer. Anyway, volume on the high end is something you want to be paying attention to in addition to the open interest. So your eye should always be drawn to volume patterns. Where's the highest volume? So for our puts, you can see right up here, volume here at 28.50, open interest at 55. Here, volume at 83.14, open interest at 11.98. Second place goes here. And so if you're doing weekly options, you want to start off by identifying where the highest open interest and volume strikes are, and then use that as a starting place for your own research. At least that's my limited understanding. I know Larry's a bajillion times more expert than I am in options, but with my limited understanding, what I like to do is help traders identify charts that are worth trading, and then within those charts, which strike makes sense. And what you'll find is that often your options expire worthless. And so to avoid that, you don't have to hold the option all the way till expiration. You can cash in early, but do be keenly aware of the premium decay and what it's doing over time, and make sure that you're trading charts that have the best directional volatility to get yourself kind of a jump start on odds being successful. Kind of like I used to play tournament poker in Vegas a lot, and I won my first tournament 7 years ago. And you know, if I'm late position with ace king suited, that's kind of this chart. You know, if I'm looking at a chart like this, why on earth would you be trading options in, say, UWT? I like it for crude if it bounces, but it has no directional volatility. It has no strength of trend. So obviously your odds of making any options trade on this, unless you're betting it to go flat, but any directional volatility play doesn't make sense. So make sure that you're trading. My biggest message to you is learn how to trade charts with extremely strong, consistent directional volatility as a precursor to identifying the strike that's most likely to work out for you. And that's one thing that I know many options traders have told me, even though I don't give them the specific strikes to use and all that, I give them the charts worth trading. And that's one thing that can really be a big help to you in your trade. So that's kind of my message. I don't really have a whole heck of a lot else to say. I'll probably end a bit early, but that's one of the things that I want to look at. Let's take a look for trading plays. I mean, I got plenty I can teach you. One thing to look at, for example, is recovery plays off of bases. And a good example is canopy growth. I started a new swing trade on that today, just a handful of shares. I like to trade the underlying. It had good news on Drake, the singer, partnered with them, and then some bad news and a whole week of sell-off. It's starting to bounce. The first place would make sense for a directional play would be somewhere over 22. This is one of those beaten down pot stocks that has had a long way down and starting to bounce. Just like we've got a long way down and starting to bounce in our inverse instruments. Again, I'm long just 130 shares of SQQQ. I'm in 400 TVIXs. I'm in some VXX2 as well. But from a directional volatility standpoint, you want to look for extremes. And you want to trade when you've got an edge. So for example, you know, something like this, you might want to trade some of the inverse instruments, buying calls on either weekly or longer term, preferably weekly options on a pivot using the previous trading range as your strike for the exit. So maybe a weekly up at 20 or so. And so you're looking for the most likely next run up. A quick tip for all of you who are fellow bears in the making. You want to trade the outlier charts that have the biggest strength. Question from Peter, how do I define directional volatility? Well, I look at a few things. I mean, the main thing is the primary thing for trading successfully is the range. And I wrote about that in one of my stocks and commodities articles. And I wanted to say thanks to all of you who voted for me. I'm the #1 rated author in the world for Stocks and Commodities Reader's Choice Award for last year. And I thank you all for that. The most important thing that will get you successful as a trader is number one, not over here. The math is so much more important than the chart patterns. If you learn nothing else from me, it's not the chart patterns, it's the math that counts. The math and the numbers and position sizing and scaling and directional volatility and all the rest of it as a function of trading range is much more important than classic chart patterns. It's like, okay, we've got a bullish cup, that's good. But you're probably going to get stopped out. Hey, another bullish cup, I got stopped out again. Then it runs without you. Welcome to my world. I've done tens of thousands of trades, and the most important thing that you want to do when it comes to scanning for high probability charts is to look at the trading range, the number of points. That's the heart of directional volatility, is this part of the chart, not this part. It took me 20 years to learn that, so you're welcome. But that's one of the things that you really want to pay close attention to. I like to use the 1-year chart. I like to also use the 90-day chart for kind of a close-up view. And then, of course, for intraday trading, I use the 1-day 1-minute chart and the 2-day 1-minute chart. This is a good example of a directional volatility play that's been going on for a month in this stock AES. Notice, please, I'm a professional trader. I have no idea what this company is. I have no idea why it's going up other than more buyers than sellers. What I care about is my eyes are drawn, number one, to the range, Number two, to any volume patterns. We have an increase in volume. Today we've got 90-day new high volume on a day where the stock market drops, so it's relatively strong from a relative strength standpoint. Here's another pattern to be on the lookout for, kind of a jump start or kickstart for your weekly options. When you're looking for a recovery play, do look for large green candles that bisect a 200 SMA, right? Like any professional trader, we use the 50, 100, and 200 simple moving average lines. When you see wide candles, I'd like it if it had larger volume, but volume's healthy enough. That's often the jump start of a good move to the upside. Another thing to look for is the ratio of green to red candles, like the air fuel mixture and the ratio of an old car back before electronic fuel injectors. But I used to work for Ford Motor Company as a statistician and a quality engineer, so I'm a hardcore numbers guy. Manufacturing quality engineering is so much more difficult than trading. I won't even get into design of experiments and fractional factorials and control charts and CPKs and all the rest of it. As a trader, look for simple things like the ratio of green to red candles. If it's all green, that's good. If it's starting to turn a little bit red, with 2 red candles or more on a pullback, not so good. So we want to see if the 2 red candles and a doji doesn't count because that's undecided. What you want is whole real body red candles. If the S&P loses 3090, you might want to be buying some puts in the spiders or whatnot. With the price projection, again, how far did it run the last time it runs a week? Not too much. It kind of ground around sideways. As the bulls were in charge on the way up, large green candles turned into dojis and relatively flatter candles, and we have a big drop. So anyway, directional volatility is really important to be keenly aware of when it comes to directional options trading, because you really want to focus on the range, the pattern of the trend, the lack of pullbacks, which is always good, and the relative strength of it compared to the broad market. Something like this is all over the map. So despite the fact, this is a good example of what not to trade, MBT. Got a shooting star. Warning, Will Rogers. Warning, Will Robinson, I'm sorry. I like 60s TV anyway. But unlike I Dream of Jeannie, we don't have a beautiful chart up here. Nothing Barbara-esque up here. This is choppy all over the place, so you're likely to not make any money trading this chart. Despite the fact, and one thing that traders often get, I guess, drawn to the wrong direction is they look too far back in history. I mean, yeah, it had a nice big run, but that was then, this is now. The last 2 weeks, it's sketchy as heck. It's kind of a Christmas tree. Green, red, green, red, green, red, green, green, red, green. So if the ratio of candles is mixed, probably not a good candidate for either a directional trading the underlying or an options play. So those kind of qualifying technical patterns, relatively easy to learn. But what you really want to focus on are rock star charts that have not only the range, but the consistency of trend. Okay, that's really important. You have my word on that. I'm a guy who's traded millions of dollars worth of stuff at real money trades, and of all my winning trades and all my stops, what I've learned is be much more selective and much more disciplined in your choice of instruments. And that sets up potential success much easier. Make life easy on yourself. Trading is as tough as it is. You want to be able to trade instruments. Another fallacy or thing to avoid getting sucked into is, the day's hot charts. So Uber was a good chart today. And for day trading, it's fine. And in fact, I called it for my members long today successfully on a breakout on this, but it's not any good you would never trade options on this thing. Why would you trade options on this crappy chart? It's a drop and chop, one hit wonder, bounce. That does not an options trade make, nor does it make for a good swing trade. It's fine for a day trade. Some instruments, because the nature of their volatility, are better suited for intraday trading than for swing trading or for weekly options trading. So make sure that you're aware of the difference between that kind of chart and you're not kind of led astray by the day's hot gaining chart, because that does not a trade make for anything overnight. It was good for today up until around 11 o'clock, and then that was it, right? Game over. Another quick directional tip I wanted to mention, and And this can help you decide when to take premium. If you want to exercise earlier than expiration, is to be keenly aware of, astutely, and it took me better part of 20 years to learn this. The price that proves a long right is a close above the previous day's high, because machines are in control of the world and they use OHLC, right? Our open, high, low, close, OHLC data points. The price that proves a long trade, including a directional, if you're, say, buying calls and you're in a directional options trade right, the price that proves the trade right is a close above the prior day's high. So as long as something's above the previous day's high, I have a warm and fuzzy about it. If it's down in the middle of the range, that's not very good. And if it's kind of like green, yellow, red, I'm going to make up some kind of graphic with the traffic signal, with green up here and yellow here and red there, kind of upside down or whatnot. But the point is, the price that proves the trade wrong would be, for example, being long and wrong in the spiders, right? Because we closed today under the previous day's close. And I was watching that like a hawk today to help me determine whether or not to take some size off of my inverses, because I am short the market, being long the inverse instruments. The fact that we closed under the 311.20 or 31.12 on the S&P, here's the SPY chart. The fact that we closed under the previous day's low here has me still feeling okay despite the recent bounce in being long instruments like I am, like SQQQ. So when it comes to decision making for when to exercise early or take premium off the table, as long as the chart is directionally, and a long answer to the fellow's point about directional volatility, but it's a good kind of a master class on the topic. The price that proves the trade wrong, whether it's in options or trading the underlying, got kind of inverse head and shoulders here, is a breakout above and a hold into the close above the previous day's high. One thing traders do, and I specialize in trading the open. I run Trading the Open, www.tradingtheopen.com. It's been my expertise for 2 decades. But for swing trading and weekly options trading or longer, if you're doing monthlies or whatnot, the closing price is critical. That's where professional traders, we make our decisions as to whether to add, subtract, or hold steady. Now, because we pulled back off the earlier highs, I did not add shares in my SQ position because the immediate directional trend after the big, China trade war game back on, or we're not going to resolve it anytime soon. What a surprise, right? So the market sold off and then came to its maybe senses and said, maybe it's not so serious. And so our inverses dropped. But the fact that we held above the previous day's high keeps me long the position. Now, on the other hand, if we had closed up at, say, 27 or above, I would have added shares because a high volume close, it's another rider downer. If the volume had been, say, up at 200K, 250K, and the price action was up over 27, that's the most likely lead indicator for a gap up on the subsequent day. Here it's anyone's call. It could gap down here tomorrow, it could gap up here. But overall, this is a directional uptrend in the inverse. So that's another decision support tool that you can use to help identify when things are starting to move. See a question from Steve, would I buy target calls after today? Well, let's take a look at the chart. We don't really have time for a lot of questions, but I like questions. The first thing, I always have a sense of dread when a trader asks about a thing, is it worth trading at all in the first place? No, that's a horrible chart. No way in a million years would I trade that chart. It's sideways as fudge, right? Shut the front door. It gapped up today, and that's nice, but there's no consistency. So that's a good example of a horrible chart that I wouldn't trade. Now, I say that and watch it run to 180 without me, right? But something that has no history. Look at your charts like people. You want things with consistent, honest performance. Something that goes sideways as fudge like this, not worth trading, off my radar. Now, it'd be okay for an intraday trade. Actually, this one, belay that. I wouldn't even day trade this because it dropped out of the gate, lost support, then moved up just a little bit and pulled back and slowly gone up. So the answer is no, I would not trade that instrument. I wouldn't trade that in the first place. And think about it. Are you more likely to make money trading options on this chart or that chart? Just saying. I just present that for your consideration. So thanks for asking, but personally, I wouldn't trade it. So one-hit wonders, things that have been going sideways, the gap up, or do a price. Another reason to avoid, and thankfully there are usually not options available for the horribly cheap $2 biotech pop and drop one-hit wonders. Just say no. You don't want to trade instruments that have a lack of trend. Look at your charts. If you want to make money as a trader, you have my word on this, potentially make money as a trader. Look at charts as though as though you're hiring employees or finding that special someone. Honesty is the number one criteria, and you want an honest, clean, directionally volatile chart that has enough range for the risk reward to make sense, and your profit potential is there, and there's a lack of major pullbacks. Not many troublesome pullbacks in this chart. One minor one here, but this last month, it's been gangbusters to the upside. AMD2. Now, the last thing I want to cover, that's an even better chart. I like that it finally broke 40, right? And what a day it had. Today's kind of undecided doji day, but previous day, nice big momentum run. Today all over the place. Now, who can tell me, would you be trading, and by the way, if you're an options trader, don't do more than 2 contracts at a time. Don't be out there swinging for the fences. I'm going to swing 16 contracts because think how much money I could make. Be in your trading much like we are in martial arts. Start off with defense. Always think, what's my downside risk and is it acceptable? So I always like the idea of trade wide, not deep, where you're trading frequently. So 1 or 2 contracts at a time, thank you very much. Don't be out there swinging big contract size unless you've got 15, 20 years experience. But if you're less than 10 years experience, you have no business trading large size. You do have business trading volatile directional charts on small size so that things are relatively careful and safe. Another quick tip, with the market doing this, would you be trading large size or small size on long plays directionally? And the answer would be, I personally would not be doing any long directional option trades. I wouldn't be buying calls on anything other than inverse instruments unless the market takes out new highs, because we may be in pullback territory. And just like a rising tide lifts all boats, a dropping tide sinks all ships too. So don't want to be the captain of the Titanic. So if the market's going to do its epic pullback on China trade war fears, you don't want to be out there playing directional long options plays, or at least on any size, in instruments that have good trade potential despite their relative strength, because the broad market's not giving you permission. And that's kind of the wisdom of a trader. Wisdom of trader is a function of position size, risk management, scaling, and the rest of it. It's not just simply, jumping into the gun and taking your shots. You want to make sure that you've got a well thought out plan strategically based on strongest charts as the starting place. So this is all systems go. This looks good if it breaks north of 42, but because the market's in a potential reversal situation here, let me pull up our S&P. Market's in a potential reversal situation here. You really don't want to go directionally long anything right now because the market has precedence. Trade markets first and individual stocks second. All right. Anyway, that's my thoughts, and I hope that it helps you make money as a trader. It's 20 years lessons learned and millions and millions and millions of dollars. But some of the top hedge fund guys trade billions, so I can't touch that. One thing that I wanted to invite you to participate in is my free Saturday week aheads. Nothing to sell here. I just wanted to offer you myself for free. I've been doing these for on and off for 20 years. I've been doing consistently now for the last 6 years. I got over 5,500 people registered for those. And you can go to trade to get free access. And again, I like to hit the ground running, be quick and effective and to the point, and give actionable intel each week. You can join me in my live Saturday events. The link is also at the top of my website at trademastery.com. That's me when I was younger and had more energy. Anyway, even had energy for showgirls. That was kind of fun. Anyway, I like doing live seminars. Yay, we have fun. Anyway, go to trademastery.com and start with a click. Those are free. They're not pitch fast. It's like 99% content. And you're certainly welcome to join the other 5,500 traders who have joined me for those events. So thank you for being here. I appreciate it. And with that, I will turn that over to my colleague, Larry McMillan, the world's top executive. Hey,
Hi,
Larry.
Ken.
Hey, how you doing?
Good. What's that?
I
Okay.
covered all that in 30 minutes. Let me turn control over to you. Let me get that and take it away.
Let me get the right slot here.
Okay, so it should have a pop-up and offer to make you the presenter. There we go. Good shape.
Okay.
It's
You
a real
see
honor
that?
too. And traders, Larry McMillan's a legend. I mean, he's the top options expert in the free world. So, and every other world. So be sure to learn from Larry. He's really smart. I always learn things from Larry when I work with him. So appreciate it. So take it away, Larry McMillan. Thanks for being here.
All right. Thanks, Ken. So we're going to spend the next half hour going over some option-oriented indicators for predicting the market. Basically, I might have a few comments on trading options, but in general, that's what we're aiming to do. I started this company about 20 years ago after being an arbitrager on Wall Street. We started out as a derivatives research company, publishing newsletters, selling data, etc. In recent years, we've moved more into money management, both in the commodities areas, the CTA, and in the SEC regulated area, registered investment advisor. And then we do a certain amount of option education, such as mentoring or whatever. I should have discussed this with Ken, I guess, but we also do a series of Saturday webinars. Not every week, ours are a little bit more towards education. We have a specific topic that we go over, as well as talking about the broad market and having an extensive question and answer session. All right, well, let's get started here. We have four main indicators that I look at as far as the market goes. The first is the chart of the S&P 500 itself. We have a little bit of an option-oriented way of looking at that. Then we look at put-call ratios, we look at market breadth, and then we look at volatility indices, primarily VIX, but also a couple of other things that are related. So as we'll see, right now we have a lot of overbought conditions, but I started this slide with oversold does not mean buy, but over down here we also see overbought does not mean sell. So we have pretty strict rules on what constitutes a sell signal or buy signal, and an overbought market can continue to go up for quite a while. This one has remained in, by some senses anyways, overbought really almost since it broke out over to the new highs over 30.30 in October. And of course, oversold does not mean buy. We started an oversold market last December. Early in December, it remained oversold while it got crushed for the rest of the month. So here's the current chart of the S&P 500. I don't have today's line. Let me just get the right ink color here. So today we went up to like 31.20 and then backed off somewhere around 30.91 and rallied a bit again. So you can see we're still well above this is the 20-day moving average here. This is the 200-day moving average down here. And this little circle here is an upside gap that was left when we gapped out, really over what had been some resistance in the 29.50 area from the old highs. These highs back in this range, and so that was a strong upside gap, and as long as that thing is still not filled, I think the basic trend of this chart is higher. So we're in a pattern of higher highs and higher lows. It's an uptrend. We have support at not only that 30.30 I mentioned, but also most of the lows earlier in this month around 30.65, 30.70. Is there any resistance when you're at all-time highs? I mean, technically, no, but in reality, there certainly is. I mean, people have targets and other things like that, so I'll show you one thing we're looking at. And the trends are positive, meaning the moving averages are rising. So that chart's bullish as long as S&P is above 30.30, and probably really even as long as it's above 29.50. But a pullback all the way to 29.50 would be a little bit devastating to the bullish case. So right now, the chart itself is bullish, but probably overbought. And what do I mean by that? Well, we calculate modified Bollinger Bands, and I'll show you those in a second. But first, I wanted to just describe what options we buy when we have signals. And we basically look at the delta of an option as one of the most important things. Obviously, most of your trading platforms have that on there, but the delta of a call option ranges between 0, meaning let's say you have an option expiring Friday that's 20 points out of the money and the stock was up a point today, that option didn't move at all. So that option has a delta of 0. On the other hand, if you have an option that's well in the money, say 5 points in the money, and it's also expiring Friday and the stock rose a point today, that thing would go up a point. The higher the delta, the more the option behaves like the underlying. And in general, I think you want to be in options that are going to capture a good portion of what the underlying does. Otherwise, if you're buying options with very low deltas, then you're in a really speculative position. Now, Ken's given you some ways to select stocks on which to trade options, and he's successful at that. And I'm going to show you some other systems as well. And so if you're able to predict the underlying movement, then you want to capture that well with an option, and that's best done with a slightly in-the-money option. So when we get position signals on the S&P or whatever, we typically are buying SPY options 1 or 2 points in the money. That gives them a delta of 0.7 or maybe a little more. And so when we get a 1 point move in the underlying, we're capturing 70% of that move. And so I think if you have a successful stock trading system, you're able to convert it to an option trading system with a methodology like this. Now, there's more to this concept, but I don't really want to spend a lot more time on it here in this short webinar today. So I had mentioned that the equity only, I mentioned that the market was slightly overbought. We plot what I call modified Bollinger Bands, and right now we're above the 4 standard deviation Bollinger Band. So we're waiting for that to fall back and give us a sell signal. So far it hasn't, and therefore the market, the S&P chart remains overbought in that sense. Now the next thing we look at is put-call ratios. And equity-only put-call ratios we use for predicting the broad stock market. Equity-only meaning all stock options that trade. So Marty Zweig invented the put-call ratios as an indicator back in the 1950s, and it's a contrary indicator. If there's too much put buying and everybody's lined up on the bearish side, and it's time for us to do something bullish. On the other hand, if there's too much call buying, which is more the case these days, then everybody's bullish and we want to line up to do something bearish. So very simply, let's say we had IBM. At the end of the day, we sum up the volume and all the puts that traded in IBM. Separately, we sum up the volume and all the calls and divide the two, and that's the put-call ratio. Since puts are in the numerator of the fraction, a rising heavy put trading will make the put-call ratio rise. Well, usually heavy put trading occurs when the stock is going down. So you've got your put-call ratio will be rising when there's heavy put trading, and the stock will be going the opposite direction. Conversely, since calls are in the denominator of the fraction, heavy call trading is going to make the put-call ratio go down, and obviously there will typically be heavy call trading when the stock market is going up, and so again, moving in the opposite direction. I keep a 21-day moving average just in case there is something to Fibonacci, but ideally this is what you'd see, the stock price and the put-call ratio moving inversely to each other. And we publish about 450 put-call ratio charts every day on our website in an area called the strategy zone, and it's a fairly inexpensive way to get a lot of charts. We also publish weighted put-call ratio charts. I'm really not too sure if too many other people are publishing those. In any case, the theory is this, again, as the stock is falling, people are buying puts, which works great until they run out of money for buying puts. The put-call ratio makes a local maximum, and that's a buy signal for the stock. Conversely, when the put-call ratio makes a local minimum down here, that's a sell signal for the stock. So this is not a current chart, but on top is the S&P 500, and in the bottom is the equity-only put-call ratio. And you can see the inverse symmetry that exists most of the time. That's why we use the equity-only put-call ratio to predict the movements in the S&P 500. So here's the current chart, the S&P for last year. So here's the S&P 500 is on top. You can see that the previous signals in this chart are pretty good. There was a local maximum on the chart right here. That's a buy signal that came right here just after the October low. Previously, there had been a sell signal late September, buy signal in late August, etc. Now we are getting down here to very, very low levels. You can see that's the lowest level on this chart. In fact, it's the lowest level since February of 2018, right before the market broke back then. So this is overbought, no doubt about it. A lot of people have been buying a lot of calls and forcing that ratio lower. But until it rolls over and makes this local minimum, which would be a sell signal somewhere, it's still on a buy signal. And this is a classic case of what I mean overbought does not mean sell, because we have computer analysis programs that can sort of project these forward like a chess tree, if you're familiar with playing chess. And they are not yet, those computer programs are not yet predicting this thing will roll over. Now, as computers have come along, we were able to calculate another kind of put-call ratio called the weighted put-call ratio. In this case, we're looking at the dollar spent. So we take an options price and multiply it by its volume, and that gives us the dollar volume of that option. Now, you could do that trade by trade all day long and add that up. It's a lot of computer power, it's a lot of expensive data, and it wasn't giving us any better results than just using closing prices. So we just use closing prices now. And so at the end of the day, we take each option, multiply it by its closing price times the volume it traded. So let's say we do that for IBM, we take those sums of all the puts, add them up. Separately, we take those same multipliers for all the calls, add those up, divide the two. And now we're measuring the dollars being spent on bullish opinion versus the dollars being spent on bearish opinion. And it really gives us more extreme readings usually, not necessarily different timing. So here's the broad market. Again, all equity options, all stock options that trade. And you can see that while we have a similar buy signal here in mid-October and the sell signal in late September and the buy signal in late August, etc. And we are also very overbought here. It's still going lower. And again, that's about as low as we've been since February of early February of 2018. You can't see that on the chart. So again, overbought, but again, not yet a sell signal. By the way, if you're wondering how the y-axis reads here, the 190 here, which is what we got to almost last January at the depth of the nasty sell-off there, means $190 were being spent on puts for every $100 being spent on calls, which as far as stock options go is a huge number. Index options, we see that a lot, but not stock options. All right, so just to summarize here, these ratios have been pretty accurate in 2018. Really, every year they're pretty accurate. There's a few clunker signals here and there, just like there's with anything. But so far, we've been catching the swings pretty well in 2019. Right now, we're still holding on to those buy signals. And so we are overbought. So the status, I'm going to call it here bullish, but overbought because, when we're this deep down on the put-call ratio, we want to be very aware of it turning. There was another one we use, which includes index options, called the total put-call ratio. That gave a buy signal in October, which was just completed, but this is something we follow very carefully in our newsletters and indicators. This only trades about twice a year, so we've had 33 trades in the last 16 years. Of the 33, 24 have been winners. 21 have reached a 100-point gain on S&P or more, as just the last one. So the average trade here is if you took all 33 trades, you've made 61 S&P points, which isn't as much now as it used to be, but still, if you had a trade right now that made, say, 6 SPY points, you should be able to make some pretty nice money on an option if the underlying is rising by 6 points if you're buying a slightly in the money option to begin with. The third thing we look at is market breadth. And that's just the advances minus declines. We keep a cumulative total. I'm going to talk about that later. We also keep an oscillator, which is 90% of yesterday's oscillator value plus 10% of today's advances minus declines. We keep this with two sets of data, the first being the obvious New York Stock Exchange advances and declines. I can give you the starting point for that oscillator, and you can keep it up yourself if you want to. Just shoot me an email to do that. On the other hand, we also keep what we call stocks only advances and declines. This is all optionable stocks because on the New York Stock Exchange, there are things called that are not stocks. So over here, we're just looking at stocks. This is the oscillator going back to 2013 on the stocks only. And the pink line on top is the S&P 500. The oscillators, the red, blue, and green lines in the middle. Red means overbought. Green means oversold. Again, oversold does not mean sell. So if you look here, the most oversold in history occurred last December 24th. We don't, though, actually buy until it stops being oversold right there, which was, I believe, about January 6th. So we bought there. Then we went into this huge period of overboughtness, if that's a word. And we were very overbought for a long period of time. And it wasn't just this. I mean, anywhere you read, it was record volume, record advancing, record money being spent on buying. And some traders have said that, when you're have that long period of overbought like that, that is long-term bullish for the market. That may be true. I'm not a long-term trader, so I don't really care that much. But we didn't sell until here, where it finally started to come out of that. Most recently, we had a buy signal right here on October 9th, and now we just had a sell signal here on November 19th. I'm sorry, my chart is blocked off there. Let me just. I can slide this over. There we go. Sorry. Yeah, November 19th. So just today. So, we had a sell signal. This is our first sell signal that's confirmed of the indicators that we're following right now. As I said, if we're close to getting that one where it closes below the standard 4 standard deviation line, but hasn't happened yet. So just to summarize what we're seeing there on breadth, we now have sell signals from our breadth oscillators. We would have preferred to see breadth expand a lot more, and the oscillators got a lot more overbought on the last move to new highs by S&P, but that didn't happen. And to me, that's a warning sign that this advance might not be quite as good as people think it is. But again, I'm not in the business of trying to buy in, short a spiking market. So we'll just see if we get confirmed sell signals, which we are beginning to do in this area. Now, I mentioned the cumulative advance decline line. That's where you just take advances minus declines every day and just keep adding them up forever. So the cumulative advance decline line on both the New York Stock Exchange and in terms of stocks only data was making new all-time highs in early November, along with the stock market. But the cumulative advance decline lines have not made a new high since November. Let me just get this so I have this right. Since November 6th, actually the 5th. So, in the way this works, that might not be a long time, but we have been making new highs on the S&P 500. In fact, in the last 11 days, I believe we made a new high on 7 of them and 14 out of the last 16. So this is somewhat of a negative divergence, a warning sign from cumulative breadth as well. Finally, I want to end here by talking about the VIX indicators. There's two things we use the chart of VIX for. As an option, we use implied volatility for everything. But for predicting the broad market, we use VIX, which is the CBOE's implied volatility index, and is a 30-day measure of volatility. First is the trend. The trend of VIX is very important. VIX trends opposite to the market direction or a non-direction, or sometimes you have a non-direction trend, 75% of the time. So we want to make sure we are understanding VIX if it's trending. Secondly, spike peaks on VIX are buy signals. So when VIX is low and overbought, like it is right now, it's not really bearish though until VIX begins to rise. Now, it depends how much of a rise you want, but we typically look at the 200-day moving average of VIX, which is now getting down towards 15. And if VIX jumps above that, that would be a big warning sign for me that an uptrend is about to start in VIX, and an uptrend in VIX is bad news for the stock market. So here's the current VIX chart going back about a year. And a couple of things. First of all these B's on here are the spike peak buy signals that I spoke about. So here's one here. And a red letter means it was a successful signal. We have a system that we use, a very well-defined system. And a blue letter means it wasn't successful. We have rules to stop us out as well. Now, these little B's here mean that we kept getting repeated spike peak buy signals there in August, but we only really trade the first one. The others are just sort of noise. So the big, same thing here. We had one in October followed by a little one, another one, not a little one, but another one. A few days later, we just traded the first one. So this has a very long and successful track record for us trading this system. In addition, though, that's very short-term stuff, and we're not seeing that now at all. VIX, as a minimum, probably have to get up in the 17, 18 area before we'd even think about looking for a spike. But there's a couple of other things on the chart, these circles. So this red circle set off a bearish intermediate term uptrend in VIX. And by that, I mean the 20-day moving average crossed above the 200-day, and VIX itself was above the 200-day. That was reversed then in a few months later here, where the 20-day crossed below the 200-day and VIX was below the 200-day. Then we've had some back and forth goings on. We never quite got all three of those things together until just recently. Near the end of October, the 20-day crossed below the 200-day and VIX was below the 200-day. So we're in a bullish trend in VIX as long as this continues. And you might say, well, VIX isn't trending, it's just going sideways. Well, again, as I said, as long as VIX is staying low and going sideways, that's as good as an uptrend because the stock market can rise while that happens. But if VIX rises here and goes back above the 200-day, that would be a warning sign for us. And as I said, a close above the 200-day would be a sell signal, in my opinion. So just to summarize here, VIX is trendless right now, which is still bullish for stocks. The intermediate trend, that blue circle, is still there, so that's bullish as well. But VIX above 16 would be a sell signal. Now, there's another thing we look at, what I call the VIX futures construct, and that consists of two things. First, the premium on the VIX futures, whether they're trading at a premium at a higher price than VIX or not. And secondly, the term structure. So we look at, let's say, November VIX futures, and then December, then January, then February. If the term structure is sloping upwards like this, then that's bullish. So it's bullish for stocks when the term structure slopes upwards and the futures are at a premium. That's the current case today. Even after today, that really nothing changed in that regard. So we're bullish in this regard. But when the opposite occurs, it's bearish. So when these futures start to lose their premium, or especially when the front month VIX future and the second month VIX future invert, that's a very negative sign. You should take immediate defensive action if that happens. Now you might say, well, I don't know where to look for the VIX futures. Well, first of all, they're for free on the VIX futures website, cfe.cboe.com. But there's another, I call it the poor man's futures construct. The CBOE publishes 5 volatility indices every day, all the time, streaming, just like VIX. So you know VIX, everybody's familiar with that. That's a 30-day volatility. There's a VIX 9-day, symbol VIX9D. They changed from some odd symbols they had before to these more logical ones about a year ago. VIX 3-month, VIX 6-month, and VIX 1 year. So you can see here, I took these prices this afternoon about when the market was getting hit pretty hard. And you can see they still all slope upwards. So the slope here is upwards. That's bullish. If these two invert, and then especially if these two invert, that's danger. So, right now, though, you can keep an eye on those, and if the 9-day stays below the 30-day and 30-day stays below the 93-day, then everything is fine, despite what's happening in the market. It's just the rest of it's just sort of noise. So just to summarize, the VIX futures are at a premium. The term structure on the VIX futures slopes upwards. I didn't really show you the price of the VIX futures, but take my word for that. The CBOE indices construct slope upwards, and then we have the overbought condition in that VIX and the 1 year especially are quite low, but this is still a very bullish pattern altogether. So to summarize all of our indicators, we saw S&P chart was bullish and it's going to stay there until as long as it's above 30.30. There is the possibility of this Bollinger Band sell signal I talked about, but we follow that daily in our indicators, and we just missed getting that sell signal today, so it's not confirmed yet. The put-call ratios are bullish but overbought. We saw how low they were on their charts. The breadth oscillators are on sell signals. That is the one confirmed sell signal. The trend of VIX is nowhere, trendless, so that's still bullish, and the term structure is bullish. So overall, this is mostly bullish. I mean, we've got some situations here, this overbought, this sell signal, this potential sell signal. So, I wouldn't say it's wildly bullish, but it's still bullish, but we're remaining alert. Now, I mentioned divergences, and I mentioned there was a negative divergence in cumulative breadth. Another area that we often look for divergences is in new highs versus new lows. That is not diverging right now. But another one is, and that's the chart of the Russell 2000 versus the S&P. Here's going back to the middle of 2018, 2018 here, 2019 over here. You can see the trend here is pretty obvious. We're trending down here. And while there's been a little bumps, occasionally that people thought that might end the trend. Even earlier this year, they thought that might end the trend, but it really didn't. And as long as this trend is in place, that's also a negative divergence. It just means that a lot of stocks are struggling as compared to the big caps that are in the S&P 500. And so when we have these divergences, such as the cumulative advanced decline line, I have a rule that doesn't mean you short the market right then, but it does mean you don't ignore sell signals. So every sell signal you get, you've got to put some, put something bearish on. It doesn't necessarily mean you have to sell all your calls. You can still roll your calls up to higher strikes to take credits out of the positions. You can take partial credits on calls. The call systems are working, and these can be working as well. Not every system is always all on buys. We follow a number of systems. I'd say we're 8 major market systems, and it's rare to find them all on buys. We got them all on buys last end of December, beginning of January last year. But now, it's more normal now. We have been on buys, and we're starting to see some of them roll over to sells. So one thing that does come up in the fall of the year is a lot of seasonal trades, and we just closed out a nice seasonal trade in October. We have some seasonal trades based around Thanksgiving trading that we will be covering in our newsletters as time goes forward here. So, last year was a terrible December, but it really, surprisingly, there was a 140-point S&P rally right after Thanksgiving. You might not remember that because the market got crushed during December. But then the Santa Claus rally, which takes place on the last 5 trading days of 1 year and the first 2 of the next year, that had a great run because that started 1 day after the market bottom last December. So 2 out of those 3 worked pretty well. And if you're trading options, of course, you have limited risk on the losers and you can have large gains on the winners. So we will be following this and other seasonal trades as they come up, especially in the next couple of months. There's quite a bit of seasonality. I did mention that we have a Saturday thing too. Ours does cost money. Unfortunately, Ken's is free. But ours we have 3 parts to it. We go over the market itself. We have an extensive question and answer session where you can ask me pretty much anything you want as long as it's not who I'm going to vote for in the election or something like that. Inappropriate questions won't be answered. Then we have an educational seminar, and we record this, and you can have access to play it back. So if you're interested, just go to our homepage and click on the link that's right there. And there's a coupon that's in there. the people who set this up in my office were giving me another thing to use too. I promised I would put this out there, and I've completely forgotten about it, of course. But I think this is it. Let me see if this works. Chat. Send to. I'm not really sure. It says send, but I think it's just I'm just sending this to Ken. Well, Ken, there you go. You got the link.
Thanks. That'll help.
Anyways. Anyways, so that pretty much summarizes my situation here. If you wanted to contact me, that's my email address if you need the starting point on any of that. And we did have a landing page set up with Calhoun on it at one time. I'm not sure. I think that was from the last time we did this, Ken. So I'm not sure that one's working right now. So it sounds like Ken is still here. So I'm pretty much finished, Ken, right at 5:30.
Well, great. And that was brilliant on the VIX. Thank you so much. That will help me. I was not even aware that there was different time intervals out of the 30. And you look at the construct is something I will go back and replay and figure out how to use that in trading my VIX ETN. So thank you very much. I learned something that I'm sure will profit me and hopefully keep me out of trouble from getting in too soon. So highly recommend Larry McMillan. And one thing I like best about your training is you don't talk about options basics. You talk about the market, which is something that traders tend to not understand, or they don't know exactly how valuable it is until they can benefit from the training that you give. So brilliant strategy.
If you're buying an option, pretty much the only thing that makes it profitable is if you've got the direction of the underlying right.
Right, and within context of the broad market and how to pull that apart in a way that makes sense. So brilliant job. I really appreciate it.
All right. Always good to do these with you.
All right, so traders, be sure to visit www.optionstrategist.com and take advantage of Larry's training. He's brilliant, and I always learn new things. And I will profit from what you taught me today. So thanks. And and I will get this up on my YouTube channel for replay. That's youtube.com/trading television. So that's on my YouTube channel, and I'll get that up sometime within the next day or two. So thanks so much, Larry McMillan, for being here. It's been an honor and a privilege, too. You're the top expert in the world, so I really appreciate you taking the time.
All right, Ken. Thank you.
Thanks, everybody.